All right. Hello, everyone. It's Monday, July 15th. We had some technical difficulties this morning while we were redecorating and Ed's out on vacation, but we're all set now. So, we'll run through what we wrote about this weekend and some, more recent developments today. Before we do that, I want to address, obviously, the assassination attempt on former President Trump this weekend, a tragic event. But in terms of let's just discuss what it means for markets. There's been a big move in the bond market. The yield curve is disinverting pretty meaningfully. Twos, tens are at negative 23 basis points, which is the least inverted they've been since January. And then we have the 2-year versus the 30-year treasury at about flat. So no longer inverted or just about close to normalization. Really what that means is the markets are pricing in an expected Trump win and what those policies might entail. Basically, they're saying, hey, we expect, stronger growth, stocks are up, as well as potentially wider deficits. The Trump campaign has talked about, extending the 2017 tax cuts. I think the Biden administration would at least partially extend those, but if we fully extend those tax cuts, the CBO projects, $4 to $5 trillion of more deficit spending over the coming decade. So face value, the bond market saying, okay, looser regulations, we'll get stronger growth, but also potentially inflationary pressures. And that's driving long end yields higher versus short end. I don't know. I would take that value. I don't know if I'd take that move as necessarily correct. I think a conservative government, let's say the Republicans sweep in November, that, they could easily rein in spending more than we had forecasted before this. We thought a debt crisis might be the only way that Congress would finally rein in the budget. And now potentially, if we do get tax cuts, we'd also get some less government spending, and so potentially less deficit spending. So for now, that's kind of the bond market's read. But again, we're not too sure that wider deficits are necessarily or wider than expected. Granted, the deficit was already expected to be pretty wide. So we'll see how that progresses, but we'll get back to the Fed. And we had Chair Powell speak this morning at the Economic Club of Washington. Really what it looks like is both Chair Powell and a number of Fed policymakers are saying that their dual mandate is in better balance now. So inflation is making its progress lower towards 2%. Again, we still see 2% for the core PCED by the end of the year, but the Fed has basically told us that even 2.8% would be fine for interest rate cuts. And we now think that September is going to be the first rate cut of the cycle for the Fed. And the market is telling us, let's take a look at the chart right here. I'll share my screen. All right. There we go. So the market's telling us they expect not only a cut in September, but another one in either November or December. Recall the Fed meeting in November is the day after the election, so it wouldn't be crazy for them to cut in September and then cut in December. And then we have the market looking at 5 rate cuts over the next 12 months. So those rate cut hopes are helping fuel a stock market rally and really a bit of a rotation or helping the more underappreciated segments of the market in recent years. So the Russell 2000 value, SMID caps in general, even the S&P 493, basically the S&P 500 X the Mag 7, are all doing really well. On Thursday, after the soft inflation print where CPI actually fell on a month-over-month basis and then came in at 3% year over year, we saw a big rotation. So Mag 7 sell off, and then like the Russell popped 3% Friday and Monday. It's not reversing, but tech is getting a bid. The S&P 500 is back up. So that was probably a lot of short covering for institutional investors who are short small caps and mid caps, mostly because they're over leveraged companies. They have a lot of floating rate debt. They're very sensitive to rates, and rate cuts really help them. So now it's kind of a broadened out rally, which supports our roaring 2020s bull market thesis. We've seen a range of S&P target moves recently, everywhere from previous recession callers saying, hey, 4,500 is no longer our case, it's 6,000. And we've seen people go the opposite way, go from having a bullish outlook to very bearish because they see a recession. But I think what we've seen the past couple of days is consistent with the AI dominant rally broadening out to other parts of the market. And we think that'll continue this Q2 earnings season. We've already seen earnings from like Taiwan Semiconductor, for instance, beat earnings. It's another AI play doing really well. But consensus estimates, analyst estimates for Q2 earnings are starting to fall, which we typically see ahead of earnings season, but didn't for a while this time around. They're down to about 8.1% on a seasonally adjusted annual rate for Q2. And we actually think that could come in about 10% or more as the non-tech names and non-AI names start to say how, hey, AI is actually helping our productivity. We see it cutting costs for us, and we think they'll beat estimates. So let's go down to before we talk about the yield curve, which we already mentioned. I think our target move from 5,400 to 5,800, which we sent out in a quick take late Wednesday night ahead of the CPI print, is both earnings and valuation driven. So our roaring 2020s thesis is still intact. We still see 8,000 for the S&P 500 by the end of the decade, but the market, I think, is just discounting that quicker. Rate cuts obviously are beneficial to valuations, and then we have earnings kind of being pulled forward, especially as that AI trade broadens out and more non-AI companies start to use it to benefit their bottom lines. If we think about 5,400, that was 270 forward earnings by the end of the year, times a 20 times, we tacked on a 20 times multiple. The S&P is already above 20 times forward earnings, largely because of the mega cap 8 or mag 7 or whatever you want to call them. And now the equal weighted index PE should start to catch up as well and start to rise. But also as forward earnings for next year get pulled forward, we had 300 for end of 2025 in terms of S&P 500 forward earnings. You pull that forward, you add a little bit of higher valuation, you get a higher price target. So it's definitely a mix of those two. Okay, let's talk about yields. Yields are falling. Our range of 4 to 4.5% on the 10 years. That's what we expect for the rest of the year, and kind of bouncing around from there. If we get the yield curve disinverting, that doesn't necessarily mean the 10-year will drop below 4%, or really far from its 4.25%, where it's trading right now, because the Fed will likely cut interest rates at least once, if not, twice. I guess they could potentially do it 3 times this year, likely in quarter point increments. But then we'll get, the 10-year could stay steady, the 2-year would fall, and we'll get a normalization of the yield curve without the 10-year really falling or moving too much from that range. Now, I mean, this is kind of what used to happen during recessionary periods, and what the inverted yield curve used to be followed by, basically, is that just before a recession would start, the yield curve would snap from inverted to back to normalization quite quickly. But that was really because the Fed was cutting rates rapidly to shore up, to prevent, whatever financial fallout was going on from cascading into the broader economy. This time around, there's no financial crisis or economic slowdown that they're looking to prevent, or that they're looking to solve or shore up. They're now aiming to prevent a recession from starting. So they've seen the unemployment rate rise from 3.4% to, I think that was in April 2023, to in June 4.1%. And they're saying, all right, inflation is heading towards 2%. We have 2.6% on the core PCED. Let's cut rates to avoid that unemployment rate from spiking, as it did in the past. Again, we really just see this as a normalization from the pandemic. If you told me we'd have 4.1% unemployment a labor force that's growing, and we're adding 100 to 200,000 payrolls a month with record immigration, I'd say that looks pretty good. That sounds like full employment or close to it, but the Fed is clearly mindful that, or at least, seeking to avoid a recession, because in the past those small upticks in unemployment were followed then by a big spike. Here's yield curve. Again, it's at about minus 23 basis points today. But that's about where it was in January, following that kind of Q4 ebullience we had in November and December, when both the Fed and the Treasury pivoted towards easier policy. Real yields. So the 10-year TIPS yield, or real rates, actually haven't moved too much. They're still just below 2%, suggesting that some of the recent disinversion of the yield curve is more inflation expectations driven than growth driven. I wouldn't read too much into that. Stocks are up today on higher growth expectations due to a Trump win, as well as Q2 earnings. So, but that's where we are. And then this is why the Fed is looking to cut, or preparing to cut, the real Fed funds rate, taking the nominal Fed funds rate and adjusting it for inflation, continues to rise as inflation falls. So Fed policymakers think of this as a increasingly restrictive Fed funds rate, or an increasingly restrictive monetary policy stance, because inflation is falling and unemployment is rising. They want to kind of loosen a little bit, or not be so restrictive, maintain kind of the same restrictiveness throughout. I don't necessarily think that's the way you should tweak monetary policy in the short term, but it's how they're thinking of it. And it's likely why Chair Powell is signaling that rate cuts are on the horizon. And then here's a historical look at the Fed funds rate and unemployment. You can kind of see this ticking up here. Jobless claims. So this is, in my opinion, this is one of the better indicators for, it's obviously one of the most frequent indicators for the health of the labor market. It's one of a number. Before we get to claims, the JOLTS data has looked good. Both jobs plentiful remain pretty high, around pre-pandemic highs. Jobs hard to get are pretty low. The quits rate is falling, but again, towards pre-pandemic highs. It looks more like the labor market is normalizing and people are just comfortable in their jobs. So as people quit less, there's less job openings, and then therefore, smaller nominal wage increases. That doesn't mean that, people are losing their jobs per se. We've actually seen that most of the rise in unemployment is due to new entrants and re-entrants to the labor force, many of which are immigrants. So people come into the labor force, they start out unemployed, and then that raises the unemployment rate. So we have both employment and unemployment rising at the same time. Obviously, that's not kind of the historical spikes in unemployment of yore, where it's a recessionary indicator. Looking at the claims data, we had a few weeks where initial weekly claims and continuing claims were both rising. That reversed last week, both fell. It looks like the seasonal adjustment doesn't take into account some of the post-pandemic trends that happen. And both these data points are following the same kind of path they did in 2023. So as we progress through summer and exit the summer months, it looks like the initial rises in initial claims and continuing claims will start to come off. And we still don't see initial jobless claims rising above 250,000 this year. And then this is two different looks at the unemployment rate. If you look at the insured unemployment rate within the weekly claims data, this looks at who's actually claiming on a state level unemployment. It really hasn't risen for several months, still at 1.2%. So this is kind of it. If you think about, there's a lot more barriers to applying for state level unemployment. So you're less likely to capture immigrants. This kind of shows at least partially what the unemployment picture looks like without the rise in labor force. Okay, so turning to inflation, again, before my time at Yardeni, but I know Ed and Debbie for the past couple of years have expected the spike in inflation to come off over the coming years quickly from a peak. I think it peaked at 7% on the PCED. to fall quickly to 4 to 3%, and then kind of a slower grind through that last mile to 2%. And that's really what's happened this year. You can see that, the targets they set for each year and inflation kind of falling within that range. Would inflation have fallen as fast or to the current level had the Fed not tightened? Probably not. Fed tightening certainly has an impact on aggregate demand. It's helped put the goods and housing sectors into rolling recessions. But a lot of that was supply chains. You had huge supply chain disruptions during the pandemic, and then you had tons of aggregate demand increased from all the fiscal stimulus. So durable goods prices shot up. Meanwhile, you couldn't spend on services, so you were spending not only all your services income on goods, but you had a ton more income, a lot from transfer payments and other sources, and a rising wealth effect as asset prices shot up during that time. Now we have durable goods prices coming down and even deflating as there's far less demand, supply chains come into better balance, delivery times are increasing and have been consistently for several months and years. And then we have China dumping goods. So import prices from China are falling, and emerging market economies, particularly those that are oriented towards manufacturing, are doing very well and increasing production. So all that upwards pressure we had from durable goods prices is now coming down. Okay, so we had the CPI print on Thursday. Obviously, the Fed pays attention to the PCED, which is still 0.6 percentage points away from the 2% target. And CPI tends to be higher than PCED. There's various reasons why. I think the Fed obviously looks at both. One reason we suspect is probably the main one is that the personal consumption's expenditures deflator hedonically adjusts a little more than CPI. So if you think about the durable goods you buy today, if you bought a $30,000 car, it has a lot more gizmos and gadgets, and it's just more of a high-tech, better product than a $30,000 car was 10 or 15 years ago. So it tries to adjust for the quality of product you're getting as well. And then you can see the durable goods prices shot up more in the CPI and then fell much more in June. So we'd expect the PCED, which is really an amalgamation of mostly just subcomponents of CPI and PPI with a few different measurement techniques because it's compiled by the BEA, the Bureau of Economic Analysis, rather than the Labor Department. But we'd expect durable goods to deflation to continue in the PCED for June later this month. Okay, so let's look at some of the components where CPI and PCED are different. One is medical care services. Face value, you can just see that CPI is super, the way they measure medical care services is super volatile. It clearly, prices aren't deflating and then rapidly inflating that quickly. A big difference is that the PCED will include what consumers pay through insurance and also through government insurance, so Medicare, Medicaid, whereas CPI only takes out-of-pocket healthcare costs. So we think the PCED, their way of measuring medical care services, is just more reflective of actual inflation. And we broke down the subcomponents. So you can see medical care services right here. Hospital fees, again, a big difference here is out of pocket versus including your insurance. And then here's the big driver is health insurance. The CPI's way of measuring it just doesn't make sense. And it's no one looks at this inflation series and think that that's an accurate measure of prices. So the PCED's measure has been lower, and we think it's better reflective of actual prices. So the good news on inflation is that it's pretty much solely a story of shelter at this point, again, barring some geopolitical shock. When we take shelter out of CPI, headline or core, we're looking at 1.8% year-over-year inflation. So mission accomplished or achieved. Of course, so if you strip out food, energy, and housing from inflation, those are some of the main needs, right? If you strip everything out, you're just at 0% each month. The reason we're encouraged by this is because shelter is a very lagging indicator. Anywhere from 12 to 18 months does the measured rents within CPI shelter and PCED shelter lag actual market rents, and market rents are well below current readings in CPI shelters. So let's take a look at this pace. So overall shelter came in about 5.2% year over year in June in the CPI, and a 0.2 monthly increase, which was actually the lowest in several years. But when we look at the 3-month percentage change and seasonally adjust that at an annual rate, the two primary components, rent of primary residence and OER, are well below their year-over-year increases. So we expect that disinflation path to continue, which should continue putting downward pressure on CPI and PCED. One little difference between the two is that a third of CPI roughly is shelter, and it's only about 16% of PCED. So this is a little more disinflationary for CPI, but again, CPI rose around 2 percentage points higher than PCE in the first place anyway. So they're following the same path by and large. And that's it for this week. We had Q&A this morning, but I think most of the questions were about our price target, which I addressed earlier. Again, like the Roaring 2020s, the fulcrum of that thesis is rising productivity growth. And throughout Q2, we'll be updating you guys, but we really think that non-tech management teams are going to be talking about, hey, AI is this huge, it's a big beneficiary to our bottom line. And that's part of the reasons we see profit margins continuing to rise throughout the coming years. Operating profit margins tended to be a more cyclical, kind of reverting to the mean type indicator. During expansions, they widen. During recessions, they fall. We think that there's an upward trend now where more tech, more automation, more AI, more robotics helps expand profit margins, especially as big tech becomes a bigger part of overall market cap weighted indexes. But we'll be keeping you all updated, and thank you all for tuning in today, and have a great week. Bye.